Welcome, everyone. Thank you for tuning into our 2024 market update and outlook. We're going to cover lots here today, Kevin. But as always, before we get too far, we have to put the disclaimer on the screen. The legal team always makes sure that we do exactly this. So you can take a quick read through. Essentially, can't treat this as financial advice. We don't know your exact situation when we're just doing a video here, but we're happy to provide a few thoughts of what we think might happen. But you have the full disclaimer listed there. Before we get too far into 2024, our outlook and expectations, we need to have a little bit of context, Kevin. So I'll pull up some charts from 2023. You can walk us through those, and that'll give us a bit of guidance and context for our conversation on 2024.
Yeah, exactly. I mean, we need to discuss a little bit of the past before we can go to the future. And I mean, even before 2023, I sort of look at the beginning of 2022. We had that big decline, and this is based on the S&P 500 that we're showing here. So we're just basically giving a view of the U.S. market on this slide. But as you can see, 2022 was fairly significant slide down in the U.S., whereas 2023 was the exact opposite. We had a really big bounce back year in the U.S. for 2023. Now, a lot of this has to center around the basically tech market. In 2022, the market got destroyed in the US, but we had a huge bounce back in tech with AI coming in 2023. So as you can see, the US market had a lot of things going on for it. We got a little bit of a dip that happened for October, but as you can see, that rally went right through to December, and the US market basically is sitting at an all-time high right now. Now, this is sort of 2023 on the US. The Canadian side of things, a little bit different. We did have a slide in 2022 in Canada. It wasn't as severe as the US one, but as you can tell, in 2023, we did not have the same sort of a bounce back year. We've been basically flat for most of that year. We've started to pick that up closer to the end of the year. Again, a lot of this in the Canadian market does have to do with oil. We didn't get destroyed as much in 2022 because oil actually went up over the course of the year, which was a big play because we're a concentrated economy. In 2023, we didn't have that same scenario. Oil peeled off a bit, stayed sort of a flat number. So as we can see, Canada over 2023 didn't do quite as well as the US market. And that sort of gives us a scenario as to where we are. But there's more to the 2023 scenario leading into 2024, isn't there, Clint?
Yeah, that's what we'll talk about. I'm going to quickly just mention here, this is the October pivot in 23. You see it in the US, you see it in Canada, and you get this huge rally that went November, December, right into 2024, also in January of 24. So you have to keep all of that in mind when you look at 2024. We are going to look at a quick technical overview and then a quick fundamental overview and kind of synthesize all that in terms of our view. We'll start with the technical picture here. This is a very simple green light, red light type of game we're playing here, Kevin. And we're doing it from the technical side of things. The trend is really just the overall direction of the market. Higher highs, higher lows, things going up versus down. Lots of ways you can measure that, but this is the direction of the 200-day moving average. Simply speaking, trend is up in Canada and the US, so S&P 500 being US, S&P TSX, the Canadian, both green on the trend front. Breadth is kind of the participation in the rallies. It's just a couple of big companies that are moving the market, or lots of companies participating in joining that rally, lots going up. You're seeing that level of breadth in the US, both the ongoing breadth measures as well as breadth thrust. You get both in the US and Canada. Ongoing breadth measures are good. You have more new highs than you have new lows. However, we have not seen the breadth thrust in Canada, so you have better breadth in the US than in Canada. Relative strength, well, when markets do well, they don't just do well in a vacuum, they do well compared to other assets. So the stock market's been outperforming bonds, been outperforming commodities. Those are signs of a bull market. If bonds outperform stocks, that tends not to be a good thing, but you're seeing the opposite here. You're seeing strong relative strength throughout the US and Canadian market, outperforming other asset classes. That's a positive. And as Kevin mentioned, you got all-time highs in the US. Haven't quite seen them yet in Canada, but that tends to be a sign of momentum. That's one we have hit on that US market. And I have to talk about this, the all-time highs, because often folks say, oh, it hit an all-time high. It's too high. I can't invest now. You have to wait
for a
pullback. You have to wait for a correction. That's not really the case. That all-time high can be usually a bullish signal. A little bit of data here. This is from Peter Malou, and he looked at all of the all-time highs in the U.S. market since January 1st, 1988. So if you invested in every single one of them, and then you looked at your average performance in the 1, 3, and 5 years afterwards, well, that average performance was better than if you would have bought on all the other days. So you actually got some better returns on average with the all-time highs than if you had purchased in other days. The idea of I got to wait for a correction, not always the case. You might not get that correction. Momentum can carry you even higher. That's why all-time highs are typically a bullish sign. And then we have to address one of the elephants in the room here, Kevin. It's a U.S. election year. There's going to be lots of headlines on it. There already has been. We tend to ignore the political side of it because it doesn't have that much of an impact on the market. Often we say leave the politics at the door because it shouldn't influence your investment decisions. But the U.S. election cycle is set. Unlike Canada, they have a very formatted cycle, 4 years, and you can do some number crunching around that, which is what's on the screen here. This is from Ryan Dietrich. I created the table. It was his data. And he looked at the S&P 500, the U.S. market, when the midterm year is down, but the pre-election year is up. So in our case, 2022 was that midterm year, and it certainly was red. The pre-election year was 23. It was green. There's many other years that have seen that similar pattern. In each case, that election year was positive. Every other time, you've had that pattern. And in general, the election year tends to be strong. Doesn't mean it's linear. Normally get some choppiness in February and March, but overall, the election year tends to be strong. So seasonality would certainly be on the side of a bull market when it comes to the stock market, Kevin.
Yeah, you're right. I mean, if you just take a look at that election year sort of scenario, we saw the midterms, we saw the year. And again, I mean, that possibility of a change, whether it's change with a new government in or change because the government gets reelected, you can see a variety of different things going on there. And that usually leads to a positive scenario. But again, this also leads to other headlines that we've seen in regard to interest rates and things along those lines. As you can tell here, it mentions that the Bank of Canada stands pat, signals rates may have peaked. What's coming next? That's the biggest factor, I guess, if we want to take a look, where are interest rates going in 2024? Well, of course, we thought that at the beginning of 2023, rate cuts were going to happen at the end of last year. That never happened. Inflation came to a certain point. We got to this. Now in interest rate cuts in 2024, that's a possibility. At the end of 23, both the Fed and the Canadian, or the Bank of Canada, as well as the European Bank or the European Central Bank, have all indicated that they think inflation's peaked and that interest rates are now at a peak and they're going to be cut going forward. So interest rates look like we're going to find that cut. Now, at the end of 23, we were looking more along the lines of, yeah, maybe we're going to get an early cut in May or March or April. With the way the numbers have come out recently, you're probably going to see that to the second half of the year. Maybe it's a May, June, July scenario before those first cuts come. But it does look like we are not going to raise interest rates anymore, and that the next position that's going to go on is going to be an interest rate cut coming. And we could be anywhere between 1 and 1.5 points over the course of the year. Now, part of this is done with the inflation factors that go on. Inflation's been a big factor for why we've had interest rates rise. It's also been a big factor for why we've had interest rates cut. That's where we've seen things going. So inflation's been a really big target for where we're going to go with that. And inflation right now seems to be at around that 3.5% range, especially going on forward in Canada and the US. So as this market, or as this chart says, you know, we ended the year at 3.4%. The bank is expecting inflation to remain close to that 3% for the course of the year, gradually easing to the 2% target by 2025. So again, sticky inflation right now. We're not seeing it. We've come down from sort of that 8-9% to 3 really quick, but that last portion to get back to 2 is not going to be anytime soon. And if that drags out, that is probably going to be the rationale for why we're not getting rate cuts till probably the second half of the year. That is going to be a big factor, is those rate cuts coming at the second half of the year. But we do believe that rate cuts are coming, and it could be, as I say, that 1 to 1.5%. And that can do a lot of spark for the economy going forward as well.
Yeah. And we'll talk about the economy. So we did the technicals up front. We're talking interest rates, inflation, the economy, more fundamental factors here. And looking at the Canadian economy, we looked at the Bank of Canada quote for inflation. We'll look at a few more Bank of Canada quotes here as it relates to the Canadian economy. And this is all from the press release in January 24th, 2024. Lots of 24s in that. Canadian economy essentially stalled. We went nowhere since the middle of 2023. Growth will likely remain close to that zero level for the first part of 2024. So Canada's economy was actually quite stagnant throughout most of 2023 and continues to be so. No recession. We're not seeing a dive, but it's kind of doing this, bouncing along the bottom. And then the outlook going forward, economic growth is expected to strengthen gradually around the middle of 2024. The bank forecast GDP growth at 0.8, so just barely above zero there, 0.8% in 2024, and then some acceleration into 2025 at 2.4%. So Canada's economy, not very diverse. We're really loaded up in a couple of sectors, and we kind of live and die by those sectors. So no recession, but we've seen this. We've seen kind of that flatline stagnation in Canada. However, the silver lining for Canada, we do a lot of trade with the U.S., and the U.S. is in a much different position than in Canada here. Kevin, I'll pull this up. You can see some better statistics for the U.S. economy.
Well, yeah, even as we said with our recap from 2023 to begin with, the US economy had a really huge bounce back there. And we're looking that this could continue going forward. I mean, if we look at the numbers just based on the bottom there, real GDP at the end of 2023 in the US is 3.3%, substantially higher than what the Canadian market has been. And we do expect that those numbers can probably continue that going forward. They have had historic unemployment at a low rate at 3.7%. And again, their inflation is roughly the same as we are at that 3.4. So again, Feds have mentioned that before. But the US economy really has had that diversified base, and we're starting to see that it's really trucking along. As you mentioned, we're not looking recession here anywhere. That number does not signify recession in the US. Soft landing maybe, but not recession. And again, if this continues to go and you get those rate cuts later on, unemployment numbers could go lower, or GDP could go higher, and the inflation number, if it stays the way it's doing with Canada, probably closer to that 2% by the end of next year.
Yeah, and so kind of economic snapshot there, and we have to address the geopolitics factor as well. I'm not sure if this falls into fundamentals, but that's where we're addressing it, is in this section, just because it's everywhere. You can't avoid the headlines. It's been unfortunate. You had Russia, you had Ukraine, you had Israel and Hamas, and then you've had the Houthi rebellion that involves Yemen. And what does all that mean, Kevin, when you pull that into your outlook? How did geopolitics impact that outlook?
Well, in a larger overall sense, it really doesn't have as large an impact as it might have. I mean, we've had expected these events. There's something that seems to happen every single year in the geopolitical impact. And again, you'll have that initial pop that may have, and you'll have the markets pull back. When, Russia invaded Ukraine, we had a scenario. What went on? When you had the Gaza scenario in the Middle East happen, again, a huge sort of pop right there. But after that, everything seems to dissipate and you go back to normal. You work your way around it and you find that the geopolitical impact is really not as big a factor as it is going forward, because it tends to play out longer. And what we find is the economies just don't look at it the same way, and you're going to get the markets not reacting basically the way they would have if you expected this for a long-term scenario.
Yeah, an element of expectations, right? When it's a surprise, you get a big reaction, but as it plays out for longer, well, people kind of get used to it and it gets factored into the forecast, or less of an overall impact. We'll kind of synthesize this into our view. As we mentioned a couple of times, U.S. stock market outperformed Canada in 23. We expect that to happen again in 24. Economic as well as stock market outperformance for the U.S. Kevin talked about interest rates. We think those cuts are on the horizon, however, a little further away. Don't think it'll happen in March or right around the corner, but perhaps the latter part of the year. Related to that, if rates are low and are rising, bonds tend not to be our favorite asset. We tend to avoid bonds in that scenario. But in this scenario, our rates are peaking and perhaps falling. I think they're back on the table and could be back a part of that asset mix. Related to that, of course, is inflation that's peaked and is cooling. That's why we're seeing potential for rate cuts. In terms of stock market sectors, technology was by far the big winner in 2023. Continues to be the big winner so far in 2024. I don't think that the technology sector is just going to drop off, but I think you're going to see catch up in the other areas. So that could be strength for financials, industrials, some of those defensive sectors Kevin mentioned earlier. A bit of that catch up rally is part of our forecast for 2024. But I've learned this over the years, Kevin, the market does not care what I think, does not care what I feel. And there's no point getting all committed to one strategy and the market does something different and you don't react. You have to be willing to be a little flexible. So we need some goalposts to determine when are we going to make that change. And that's what this slide is all about.
Yeah, as we know, economics is not a actual science. It's a social science, because things happen that you don't forecast, and it can lead to a variety of different options. So things that could make us change our mind. Basically, I mean, if we're looking at on the technical side, the trend falters or turns down. So I mean, if the trend right now is up and we're going to see something that causes it to go the other way, that on a technical side could be a big scenario if it flattens out or turns the other way. Breadth deterioration. As we've mentioned, the U.S. market's done very well because everybody's participating. If we go back to just those 5 or 6 tech companies, that may have a big effect as to how things going forward, and the relative strength fades. So as opposed to the stock market leading the way with everything, all of a sudden you see the commodities start overtaking them, or maybe the bond market starts doing much better. That sort of relative strength fading could have an effect on what goes on the technical side. Fundamentally, escalation of geopolitics, as we're seeing right now. I mean, it started out the Middle East as the Gaza scenario with the Palestinians and basically Israel. Now you've included sort of Iran. If it goes to Iraq, if it goes to that whole Middle East scenario, escalation of that, if you bring more parties in, could have a big effect on how the global economy starts to run things. You could get that reignition of inflation. That's the biggest factor right now for their fear for why you're not getting the rate cuts, is because, well, what happens if it goes from 3.5 to 4 or 4.5? All of a sudden now that has a big effect on what we're going to see with the economy going forward, with more inflation. And of course, bigger inflation or a reignition of it, means you're not going to get any rate cuts. And the rate cuts basically have been a signal that the economy's doing well, that things are going to progress, that we're getting that back to where we should be normal. Any of these changes could lead us to a scenario where what we predicted beforehand could have an altercation one way or the other.
Well, probabilities. We're outlining what we think is the most probable view. Then we're saying these are the things that could happen that would make us change the course and adjust our strategy. If you have questions, of course, please reach out. We'd love to hear from you. Chat with clintonkevin.com. You can see it on the screen there. It is part of our website. So you simply go there, you fill in the form, it comes right to us. And we always appreciate the questions. Any parting comments for the folks, Kevin?
No, I think that's a quick scenario. If you have any more questions that you want to deal with on knowing what we think for the 2024 economy or how 2023 did and what our projections have been like, by all means, chat with clintonkevin.com. We're happy to talk to you then.
Take care.